Hi, so this is the continuation, and in the previous video we had covered problem number 6. Now we're going to cover problem number 7, right? So here we have problem number 7. These are the closing liabilities, and then opening liabilities, and then opening assets, and then closing assets. So all these are liabilities and all these are assets, and then they gave some information about profit before tax, and then after deducting the tax, this is profit after tax, and then they declared a dividends out of it. So retained profit is 1000 rupees. Retained profit means instead of declaring that profit by issue bonus shares, or by declaring the dividends, they have retained that profit to expand their business, right? That is called retained profit. So instead of declaring the dividends or issuing the bonus shares to the public, if you retain the profit in your business for further expansion, that will be called as retained profit. Now, here they give further information, and these are the fixtures and vehicles, both are assets. Depreciation, and then disposals means sale, proceeds on disposal, and written down value, and profit on disposable. Anyway, so whatever the problem it is, we have to stick to our format, right? So here we can solve this problem by using indirect method. Why? Because they gave the net profit. Like previously we have discussed, if you're able to find out the net profit in the problem, so you can solve that by indirect method, right? Okay, so let's start the solution. So first we need is net profit before income tax. So I think we can, from this we can figure this out. Net profit before income tax, which is 4500, right? So let's take that. So net profit before tax 4500. Then after that we need non-cash and non-operating expenses. We need to add non-cash and non-operating expenses, right? Okay. Okay, let's see what are all the non-cash and non-operating expenses are there here. What we can find out. So we cannot find any non-cash and non-operating expenses here. So let's come to here. Depreciation. Depreciation is a non-cash item. Previously, like, again you have to see the second part in the pro forma. In that we have discussed everything. In the P&L account, depreciation is unnecessarily deducted, right? There is no cash outflow because of that, but we have deducted. So that's why now we are adding back. So add non-cash or non-operating expenses, which is depreciation. Depreciation for the fixtures is 1000 rupees, right? And then for the vehicles is 2500 rupees. So both we will add back to the net profit before tax. Total will become 3500, right? Then afterwards we need to deduct the net non-cash and non-operating incomes. We need to add the non-cash and non-operating expenses, and we need to deduct the non-cash and non-operating incomes. So we have already added the non-cash and non-operating expenses. Now let's see the non-cash and non-operating income. So here, if you observe here, there is no such thing in this. So leave that. So let's come to here. Proceeds on disposal 1700, right? And then book value is 1000. Profit on disposal is 700. Profit on disposal, that means profit on sale of asset. When you got that profit, you would have wrote the general entry saying that profit on sale of machinery account debit to P&L account. In P&L account you might have credited that. That means you might have added to the gross profit, right? But that is non-operating. So that's why, since you have added previously, now we need to deduct that. So that's why we are deducting the non-cash and non-operating income. Profit on sale of vehicles 700, right? Only this figure, profit on sale of vehicles, we have done to the P&L account. Then, so apart from that, we can't find any expenses, non-cash non-operating expenses or non-cash non-operating incomes, right? So let's come to the next process, which is operating profit before working capital changes. So 4,500 plus 3,500 minus 700, if you do, you'll get the 7,300. Now again, previously we have discussed working capital means current assets minus current liabilities, right? So we need to form a table. So if it is a current asset and then current liability, I'm taking an example of debtors, creditors, current liabilities are creditors, current assets are debtors. So this may increase, decrease, increase, decrease, right? So if the debtors decrease, we will get the cash, right? Because we sold goods on credit basis. And then if the debtors decrease, we will get the cash. That means that is inflow. If just opposite to this one. If the creditors decrease, that means we bought the goods on credit basis from them. That means we paid them, right? So that means cash is going out. So outflow. And this is opposite to that. For clear explanation of this, you have to watch the pro forma, which is in second video, right? Okay, let's start with the operating profit before working capital changes. So we need to find out if there is any changes in working capital. So working capital means current assets and current liabilities, right? So let's start with the current liabilities and current assets. So here you can see here, these are the information related to the current liabilities. So first thing is trade payables. Trade payables, just a minute. Yeah, trade payables were in 2010, it was 2,500, right? In 2001, it is 4,000. That means increase in trade payables. That means increase in current liabilities. If there is an increase in current liabilities, what happens? It is a inflow, right? So that means we need to add that. Let's see what we did. Yeah, so increase in trade payables, we have added it. We have added 1,500. Now next one, taxation is not current asset or current liability, so we don't consider that. Dividend payable also we don't consider. So there is no current liabilities then. So then come back to the current assets. Current assets we have inventory and trade receivables. So let's start with the trade receivables. It was 14,000. Now it is 17,000. That means there is an increase in inventory, right? 14,000 previously inventory was 14,000. Now it is 17,000. That means 3,000 has been increased. That means inventory is current asset. Increase in current asset. What happened? Increase in current asset. That means it is a outflow. So 3,000 outflow. So put in the bracket figures, right? Then trade receivables. It was 6,000. Now it is 8,000. That means increase in trade receivables. Again, increase in current asset. So it's an outflow. So put in the bracket figures. So there are bank and cash we won't consider even though it is a current asset, because at the end we will consider that. So now we will get the cash generated from operations. From this we need to deduct the income tax. Then you will get the net cash generated from operations. So income tax. So we need to find out whether they gave any other taxation provisions like that. So here if you see, they gave taxation. It was payable at the beginning of the year was 2,000 rupees in 2010. In 2001 it is 1,500, and then they actually paid is 1,500. So we can find out this 1,500 is actually paid during the year, right? Opening, add to the opening to that. So 1,000 minus closing. Closing is how much? 2,000. Sorry, 1,500. 1500 get cancelled, remaining 1000 will remain, right? So we need to deduct 1000 rupees as a income tax paid. So net cash generated from operations will be 2800. After that, investing activities, cash flows from investing activities. So we don't need this, so let's wipe this off. So investing activities, so we need to find out, is there any cash inflows or outflows relating to the assets, right? Buying and selling of the assets. So now fixed assets at WDV. Premises was previously it is 10,000, now also it is 10,000. That means that it didn't buy anything or sell anything, so we don't need to worry about that. Whereas fixtures was previously it is 11,000, now it is 17,000. That means there is a change in fixtures, and also they gave the depreciation about that. So to get a clear picture, it is better to prepare fixtures account, right? So let's prepare one fixtures account. Fixtures account. Now fixtures is an asset. So opening balance you need to write in the asset side. Opening balance is 11,000. So to balance brought down 11,000, right? And then 17,000 is the closing. So right opposite to that, by balance. Just a minute. So I think we need to start fresh. Let's start here. Fixtures account. To balance brought down. How much? 11,000. By balance carried down, which is 17,000. Which is 17,000. So we got the opening and as well as the closing, right? Next, they charged a depreciation. How much? 1000 they have charged the depreciation, which is given here. On fixtures, they are charged the 1000 rupees depreciation. What is the general entry when you charge the depreciation? Depreciation account debit to fixtures account, right? Fixtures account. So in fixtures account, it is by depreciation. How much they charge? 1000 rupees, which is given here, right? Alright. So apart from that, there is no other information given in the question. So let's balance this. So 17 plus 1, 18,000, and then put the bigger number in both sides, 18,000. Now there is a shortfall of 7,000 here. So we can consider that this is nothing but purchases to bank purchases of new fixtures during the year. That is the general entry will pass, right? When you purchase a fixtures, what do you write? Fixtures account debit to bank account. So in fixtures account to bank 7,000. So purchase of fixtures, that means purchase of assets, which is an investing activity, investing cash outflow. So that's why purchase of fixtures 7,000 we will put on the negative figures, right, in brackets. And then vehicles. Let's come to the vehicles. In vehicles also, if you observe, the opening balance is 8,000 and then closing balance is 12,500, which you can see here. That means there is a change happened during the year, and then they gave the depreciation, and then they gave the sale of vehicles also. So it is better to prepare one vehicle account to get a clear picture. Alright. vehicle account. So vehicle is an asset. So we need to write the opening balance in the asset side. So to balance brought down, right? And then closing balance in the credit side. So which is by balance carried down. Let's see how much is the opening balance and closing balance. So opening balance given in the question is 8,000 and closing balance is 12,500, right? So we'll write that here, 8,000, 12,500. Now depreciation charge during the year is 2,500, which is given in the question. So when you charge the depreciation account debit to vehicles account. So in vehicles account by depreciation, which is 2,500. And then we have sold one vehicle which is the original value was 1,700, and then we have depreciated 1,000 rupees, right? 700 is the profit. So we have sold it for 1,700 and then depreciation is 1,000, profit is 700. So when you sell a machinery or when you sell a vehicle, what is the general entry you will pass? Bank account 1,700 we are getting, so bank account debit to vehicle account. So in vehicle account by bank 1,700. Alright, okay, so it's done. And the depreciation we already taken care here, total depreciation for that, so we don't need to write again depreciation, right? And then profit. So what is the general entry you will write when you get a profit? Profit on sale of vehicle account debit to P&L account. In P&L account you will credit that, right? Remember. So here profit on sale of vehicle account debit to P&L account. So that means in vehicle account that is to P&L, which is for how much we got profit? 700, right? Yeah. So now we can do the balance of this. Let's do the, take the calculator. So 12,500 plus 1,700 plus 2,500. Total this side is 16,700. And then here 8,000 minus 700, right? So 16,700 minus 8,700. 8,000. So 8,000 is shortfall here. That means we have bought new vehicle during the year is 8,000. 8,000, right? So this is also investing cash outflow. And also if you observe one more thing, They sold it for 1700 written down value method. Sorry, this is written down value method. That means this is the value of the machinery, and then they got the profit of 700. And if you observe in the ledger, they have taken out the value only, not the depreciation. They have taken out the value only. So 1700 was the they got by selling, and then 700 was the profit. That means remaining 1000 is the value of the machinery gone from the account. 1700 minus 700. Okay, fine. So vehicles 8000, and sale of vehicle is 1700. So this is the money, actual money. We have to take 1700 only here, because that is the money we have received. Cash 1700 cash came in, so we should not minus 1000, and we should not consider only 700, because 1700 we got cash inflow, so that way we need to consider 1700. So if you do plus and minus, you will get the 13,300. And then cash flow from financing activities. Next, cash flow from financing activities. So here there is a dividend payable, and then here there is no other here, down here, and then here equity share capital. Opening was 50,000 and then closing was 60,000. That means remaining 10,000 we have freshly issued the shares, right? So issue of shares is 10,000, which is the cash financing cash inflow, and then dividend paid. So dividend, declared dividend, there is here. During the year we declared again 2000 dividends, and then there are dividend payable accounts. We haven't paid this 2000, we just declared it, right? So that we have a dividend payable account which shows, hold on, yeah, so here which shows 1000 rupees was the opening balance, and then 2000 rupees was the closing balance, right? So let's prepare an account so to get the clear picture. So dividend payable is a liability for the company. Liability shows credit balance. So dividend payable was 1000 rupees. So by balance carried down 1000. To balance brought down was 2000. So this year also, so whenever you declare a dividend, you will transfer to the one account called as dividend payable, and the dividend payable you will record in the balance sheet as a liability. So in this year also, during this year also, you have declared 2000. That means this 2000 also you will transfer to the dividend payable account. So dividend payable account. So what is the general entry you will pass? So you are increasing the liability. Liability shows credit balance, and if you are increasing it more, that means you need to credit again. So dividend account debit to dividend payable account, right? So that means we are doing the dividend payable account. So by dividend, so this is the dividend you declared during the year. By dividend 2000. So we need to find out actual how much we paid. These are all declared only, we didn't pay anything so far. So we need to find out how much we paid. So here it will become 3000. You need to post here also 3000 minus 2000, it will be 1000. That means this is the money we have paid to dividend paid, which is 1000 rupees, right? So this is also declared dividend during the year. This is the during the year we have paid only 1000 rupees. So that is the 1000 rupees only we need to consider as a financing cash outflow. Which is here, right? And then so total if you do 2800 and then minus 13300 minus 1500, sorry 9500, you will get the minus 1500 net decrease in cash. And then if you add opening to that, opening cash, so which is given here 8500. So 8500 minus 1500, right? Cash and cash equivalents also we should consider, right? So 8500, sorry, it was a little bit slow, please hold on. So 8500 and short term investments is the cash and cash equivalents. Let me wipe this off. Yeah, so opening cash is 8500 and then short term investments, opening short term investment is 1000. So 8500 plus 1000, so total 9500. 9500 minus 1500, net decrease in cash is minus 1500, and you will get the closing is 8000. And if you tally this, you will get the same answer. So bank and cash is 6000 cash, and then cash equivalence is 2000 opening, closing, right? So 6000 plus 2000, 8000, which is we got here, right? All right, see you in next class.